Hello, everyone. Today on the Final Bar, we're talking to Katie Stockton from Fairlead Strategies. Happy Fed Day. We're going to talk about this environment. The entire, landscape of the markets sort of shifted in the short term during Powell's press conference. He had a nice bounce with the major averages finishing higher, about 3% for the S&P and the NASDAQ. We'll talk about what this short-term bounce means relative to the long-term trends and focus on asset allocation. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis, using the technical toolkit to better understand what investors are thinking, how they are voting with their capital, and how that is represented best by stock prices. Quite the day today. Yesterday, we talked about sort of the calm before the storm, that's choppy sideways day, setting the stage for Fed Day. Fed meetings have certainly been choppy historically, but now more than ever, as we're sort of in, pun intended, uncharted territory for a lot of newer investors that have not been through this sort of period of rate hikes and potential rate hikes, and what that means for inflation, what that means for different asset classes, growth versus value, just equities in general, and so forth. So we're here to help you along this way and make sense of things. Not unusual to have a bit of a bounce afterwards. So the meetings, the announcement first comes off at 2 p.m. Eastern, around 2:30. We have the Powell press conference. Certainly a bounce higher through the course of the afternoon, going into the close, as it becomes a little more clear, a little less probable that you'd have anything more than a 50 basis point rate hike as the next one. And I think that's calmed people down a little bit, that we're nervous about the prospects of greater rate hikes. As always, I was talking with the StockCharts TV team before we went live today, though. I'm always fascinated by how much we're hanging on that press conference. And my question, my comment to all of you: how much has the world really changed in the last couple hours in terms of the prospects of inflation, in terms of what higher rates are going to do most likely to different sectors? I think a lot of those challenges still very much in play. We have a great guest today. Katie Stockton is one of the best, and she'll share some of the charts that she is paying attention to. Tomorrow, on Thursday the 5th, we have Christopher Mullen from the Technical Traders. On Tuesday, May 10th, we have Larry Berman from ETF Capital Management in Toronto. Then on Wednesday of next week, on the 11th, John Gagliardi from Fidelity Investments is going to be joining us on the show, once again sharing some of the charts that are top of mind for him. Let's continue on with our market recap and focus on some of the key charts that tell the story of this volatile day with quite the surge to the upside going into the close. The S&P, with that move to the upside and the bounce around 2:30 p.m. Eastern, gets it right to around 4,300. That's where we settled in for the close. That's about 3% higher from yesterday. Yesterday, pretty flat, choppy day, not a lot of movement. And today, resolving to the upside after a fairly quiet morning into early afternoon. The NASDAQ composite, the NASDAQ 100, outperformed a little bit more, and the VIX now well below 30. It's interesting. We looked at the chart of the VIX in the last couple of days, I think at the end of last week as well. And if you look, it's been sort of range bound. When it's gotten above 30 over the last 6 months, that's tended to be a short-term market bottom. We just saw that over the last week. And then sure enough, we're seeing a bounce to the upside today. So continuing to follow through on that pattern that we've seen recently. Interest rates, quite a bounce. Obviously, a lot of asset classes chopping around and quickly changing gears going into the close. So rates had been higher, with the 30-year well above 3%, 10-year yield above 3% as well. Came down very quickly as bond prices rallied during the Powell press conference. 10-year yields coming off, now settling in around 292. The dollar index down pretty big as well. Not a ton. I mean, 0.8% on the UUP. But the dollar index has strengthened. That dollar index, the long-term trend in the dollar index, has certainly been one of the key stories to focus in on through the course of the year so far. Dollar weakening certainly opens the door for things like gold and silver to appreciate. Those things are denominated in U.S. dollars. So when the dollar is super strong, Even a traditional inflation hedge like gold is struggling to make gains to the upside. But the GLD actually pushing higher through in the afternoon after the 230 cutoff. The DBC, the broad commodity ETF, actually continued to push higher through the course of the day. Energy prices, oil prices, natural gas prices, all moving higher. And the energy sector, by far the top performer of the day. Cryptocurrencies really turned in the afternoon, bouncing higher. Bitcoin once again testing that 40,000 level. We've talked many times about those big round numbers and how they tend to have meaning in a lot of charts, but particularly with cryptocurrencies, with Ether around 3,000, with Bitcoin around 40,000, and other major round numbers, we've seen that sort of play out. So it's interesting that given the bounce, both Bitcoin and Ethereum right back up to those key levels, 40,000 for Bitcoin, for Ether, 3,000 just below that. All 10 of the most liquid coins that we follow on StockCharts, well in the green as we're shooting this right after the close on Wednesday. Let's continue on with the daily chart of the S&P 500. So it's worth noting when you see a bunch of green on your monitors, it's certainly cause for celebration in the short term if you're bullish and seeing that rally. Just a friendly reminder, we are still very close off of long-term lows over the last couple of days. We've bounced higher. The S&P settling in right around 4,300 on our daily chart of the S&P. That's that orange shaded area. Now we've been focusing on that price level for quite a bit because that's actually where the market bottomed out in the third into the fourth quarter of last year. September, we first pulled back to that support level around 4,300. We bounced off there again in early October, and then that set the stage for the rally going into year end on the S&P 500. The NASDAQ sort of petered out before then, but the S&P sort of accelerating to new highs in the first week of January. From then, we've actually obviously come back lower. We earlier in the last week got below 4,100, but closed back above it. We're now back above 4,200 and right at that 4,300 level. And so this is a level we've bounced off of a number of times over the last couple months. In the short term, be interesting to see if we're able to regain that level and hold it. In any environment, as I would remind you, a downtrend is a pattern of lower lows and lower highs. And as we're looking at some of these names that have certainly bounced, I mean, a lot of the FANG stocks, all of them obviously bouncing as the markets as a whole are pushing higher. Meta Platforms is a great example chart to look at. A decent rally, an impressive rally off of the lows just below 170 just under 2 weeks ago, pushing higher, still not making a new swing high though, right? So if you zoom out, if you take a look at this chart, we're still making a pattern of lower highs and lower lows. The reason why I'm sort of making that point here is I think when you have this big bounce, a lot of people would say, ignore what happens on Fed Day because there's a lot of anticipation. There's a lot of pent up demand and supply that sort of gets unleashed after the Fed meeting is wrapped up. And then you start to see what the long-term trend continues to be. And so I would say on charts like Meta Platforms, making a new swing high would very much be a bullish development. Making a higher low would make me more confident that we're starting to develop a bottom that has a meaningful bottom of sorts. Otherwise, this still feels like a bounce, albeit a very impressive bounce off of the lows. We're on 170 to just above 220. You want to see if some of those charts can regain some of those previous highs. Even charts like Alphabet, right? So if you look at the chart of Google, if you take a trend line and basically take the 2,500 level, and I'll make that a little bit bigger so we can see it. 2,500 is where we bounced off in January, in February, in March. Very closely got there in April. We finally broke down there. And as we talked about last week on the charts of the what I call the FanMag stocks, those 6 mega cap tech and communications consumer names, breaking down through support was pretty key. And some of those charts that had been holding support now starting to fail, right? Apple getting below its 200-day moving average, Alphabet getting below support around 2,500. With that big move higher today, up over 4%, impressive move off the lows, we still haven't regained that support level. So these sorts of charts have had nice bounces. I'd like to see them regain previous levels of support, which would arguably or potentially now become levels of resistance, because a classic technical pattern is a breakdown of support, a retest from below, and that sets you up for the next big leg lower. And that's certainly on the table. That's something that you could see on a growthy stock like Alphabet, given the fact that rates are certainly don't have this tendency or this potential to move higher than where they've been so far. So some nice bounces today, but some interesting charts to pay attention to in terms of some key levels. Just to finish off our market recap, let's look at the sectors. So All 11 sectors in the green today, from very strong to a little bit strong. Energy at the top of the list, followed by tech and communication services. Those are some of the FANG stocks that I mentioned, with some nice bounces. Again, many of those coming off of fairly beaten down levels, but an impressive run that now starts to put some of those previous support levels into play as potential resistance. On the downside, you have the underperformance of some of the more defensive parts of the market. Real estate up just over 1%, healthcare, then utilities, and then consumer staples. We've talked often about that ratio between consumer discretionary and consumer staples as a general measure of offense versus defense. While you're seeing a bit of a bounce today, certainly in consumer discretionary, you're also seeing a bounce in staples. So that ratio really isn't changing a ton. I'll show you quickly here. If we go to the Mindful Investor Live chart list, we go to our chart looking at that difference, that ratio of the two, of consumer discretionary to consumer staples. Let me find it here in the ratios category. Here we go. First one off. This is a cap-weighted version of that ratio, consumer discretionary underperforming consumer staples. On the bottom, we have the equal-weighted version, consumer discretionary over consumer staples on an equal-weighted basis. Both of these have been trending downwards for quite some time. This bounce today is just this little bit of the bounce at the very end of this chart. So my point of this is nice bounce higher after the Fed meeting, certainly encouraging, and a nice bounce higher amid a series of weeks which have been fairly negative. I still think there's some development needs to be had to confirm any sort of meaningful rotation, particularly ratios like this that still show a bit of a risk-off environment, broadly speaking. Let's take a quick break. We'll be back with today's guest, Katie Stockton. We'll see you in a minute.
What if you could look beyond price and identify big moves in the market before they happen? That's why we created the Moxie Indicator Minutes. Hosted by me, T.G. Watkins of Simpler Trading, the creator of the Moxie Indicator. Each week, I'll provide you details about the indicator, what it does, and how it can work for you. Only on StockCharts TV.
Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's great to have you join us every weekday after the close as we break down the activity in the markets using the power of stock charts, using technical analysis tools to better quantify investor behavior. A couple quick announcements before we get to our guest, Katie Stockton. First off, we're going to feature a mailbag segment on Friday's show of this week, and we would love to feature one of your questions live on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. We have great, knowledgeable expert guests like Katie Stockton, Jeff Weiss, so many others that have come through the Final Bar and our other shows. Also, special events like The Pitch, which Katie was on just recently, our Stock Charts Draft, which aired last week. So much great content for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Katie Stockton. Katie's the founder of Fairlead Strategies, also portfolio manager of the new tech ETF. Katie, it's great to see you. Welcome back to the show.
Thanks, Dave. Good to be back.
So Fed Day is always a fun day as a technical analyst to try to apply our craft and digest these quick shifts in the market. You have some charts that you brought with us to try to sort of tell the story of your perspective. We're starting with advancers, decliners, looking at breadth. What is this telling you?
I think we need to take a step back and just acknowledge that there's been some real deterioration year to date, but even before that, you could see it in market breadth or participation. We like to track breadth a lot of ways, some of which are oscillating measures like the percentage of stocks above their 50-day moving averages. Others like this one, which is the cumulative reading of advancers and decliners on the New York Stock Exchange. And you see that it has a bit of a topping formation, sort of a rounded pattern there at the top. And now it's broken some support based on the shaded area, which we call the cloud model. And, breadth, when it deteriorates, you tend to have a weaker tape, meaning momentum is to the downside behind the S&P 500 and the like. So it just also makes it much more difficult, I think, to find stocks to take advantage of the upside, especially when the upside doesn't tend to last all that long.
It's a great point. I appreciate you taking a step back for us. It's so easy. I know a lot of us get drawn into the short-term movements on a day like this. Your second chart is looking at bonds. Obviously, a lot of movement in all the asset classes, but particularly in the bond markets today, given the Fed meeting. What is the TLT chart telling you?
Well, we featured TLT today in our weekly report, and we did that because now the downtrend, which is still supported by negative momentum, is showing some signs of downside exhaustion based on the DeMark indicators in part, which are a way to understand trend exhaustion. And it's really the first signal that we've seen on the buy side, so to speak, in years. So we're kind of intrigued by that. At the same time, we have the counter trend signals unfolding on the sell side, if you will, in treasury yields. So there's a lot of reasons to expect yields to stall in here. And for TLT, which represents long-term treasury bonds, for that to stabilize. Also, the downtrend has reached a point where it's approximately at its measured move projection, meaning from its latest breakdown, it's sort of extended that original downtrend by about 100%. And that's what you usually can feel safe assuming is that a trend will maintain that kind of trajectory. And it's at that point, again, where it may find support based on that measure. So we do have an enhancement, if you will, of those oversold conditions. I wouldn't call it a strong, high conviction buy signal, but I would say that it is something that suggests that we'll at least see some stabilization.
Interesting. It's certainly a chart to watch. Now, one of the great stories of 2022 has been the strength in energy stocks driven by crude oil. What's your take on that space here?
We are overweight the energy sector, and it's simply because it's trending higher in relative strength terms. So if you look at measures like the S&P 500 energy sector index versus the S&P 500, you'll see uptrends there. And it doesn't really show any signs of relenting as people are drawn to commodity prices, which kind of feel in this tape like they're the only thing that are working to the upside. And just this morning, we noticed that both natural gas and crude oil futures were pushing through some minor resistance levels. For crude oil in particular, we've been watching this triangle formation. A triangle, as you know, marks a converging trend line, both on the upside and downside. And it reflects an indecisive period typically for a security like crude oil in this case. And usually we find that the triangles are fairly high probability as price patterns that when they are broken one way or the other, they tend to yield pretty good and immediate follow through. So we like to see these triangles when they're resolved. And in this case, it does seem to be resolving higher. And that's only natural because it is more of a continuation pattern. And of course, an uptrend preceded it as opposed to a reversal pattern.
Now, your last chart, natural gas, already coming off of new highs here recently. Is it more of the same expected here?
And these are short-term breakouts, but yes, it's clear minor resistance level. And you can see very, very strong positive momentum behind natural gas futures. And that's served as an impetus for a little rotation back into the energy sector, which had also pulled back. The pullback in the energy stock related to natural gas and crude oil had been a bit more dramatic than for the commodities themselves, we found. And now they're at the point where they do seem like they have at least a short-term opportunity for upside follow through. The intermediate term, we've seen a little bit of a downtick there. But again, it's about folks finding areas of the market that are actually working. And I think people generally are more comfortable taking advantage of these kind of uptrends and following the momentum as opposed to counter trend trading.
Katie, we have to leave it there. I couldn't have asked for a better guest to inject some calm and reason in a time when it's easy to get very caught up into the flickering ticks of this day. Great to see you. Thanks again for coming on, and stay safe there, okay?
You too, Dave. Take care.
That's Katie Stockton. Katie's the founder of Fairlead Strategies and portfolio manager at the new TAC ETF, which is a tactical sector rotation ETF. If you caught, Katie's fantastic. I've known Katie and followed her work for many, many years. And she made a quick comment in there. I don't know if you caught it when we was talking about energy, talking about being sort of overweight the energy space because of the relative strength. And if there's one goal of mine as I've worked with more and more individual investors and financial advisors through StockCharts and through my own firm Market Misbehavior, it's to encourage you to focus on relative strength. That is where institutions tend to focus a lot of their energy. On the institutional side, it was all about the relative game. What's working and what's not relative to all the other assets or all the other stocks or ETF we could put in a portfolio. And I appreciate very much Katie's perspective on including that, looking at things like energy, natural gas, and elsewhere. Go where the money is flowing. Great take there from Katie Stockton. Let's continue on with today's show with our next segment, Don't Fight the Fed. I don't know how much I can add relative to Katie's comments. She was a great guest to come on today because, again, there's a lot of movement that comes around the Fed meeting. What we like to do on a day like this is just sort of take a step back and reflect on what's happened leading up to the Fed meeting, what's happened afterwards, and not to throw cold water on what's happened in the markets after the press conference today. Certainly a move to the upside. The prospect of rate hikes not being as aggressive, the Fed not being as hawkish as it certainly could have been, as you hear the language in the press conference this afternoon. It all seems pretty encouraging in the short term. My question, as always, is how much has that changed the long-term picture? And I think that's where you look at the breadth conditions like Katie was showing. That's when you look at the overall trends in some of these charts. There's a lot that would have to change for these markets to look differently, dramatically than what you've seen in recent weeks. In recent weeks, we've been talking about the follow through to the downside, the extension, a lot of these movements, stocks failing to hold support, making new swing lows. At the same time, you're finding stocks like DVN and Valero and other energy names bouncing to the upside. I put one of those, I forget which one, as one of my 3 and 3. We'll find out here in a few moments. It'll surprise me too when I bring it up. I did put one of the energy stocks, I think, as one of the 3 and 3, making new swing highs. So there are stocks that are working, but generally speaking, you're finding this continued movement of value over growth. You're finding stronger commodity prices and the challenges related to that, what that means for inflationary concerns and elsewhere. So let's look at some of these major asset classes going into the Fed meeting, what today's bounce means relative to the long-term trends. The S&P we talked about earlier, and again, we're coming off of long-term lows. We're coming off of new lows for the year on a closing basis, on an intraday basis that happened over the last 4 trading sessions. So at this point, getting above 4,300, I think, is a key level. Even above there, want to find a higher low, and that's what the S&P has been unable to do with a lot of individual names as well. We talked about Alphabet earlier, so we talked about that. Let's talk about some of the other asset classes as well. I was interviewed this week and was asked about interest rates, and to paraphrase, the question was how high can rates go? The 10-year yield was above 3% earlier that it kind of came off as bonds rallied. And I think the comment that I sort of suggested to people when I was asked is that, have rates had an incredible run? Have bonds had a deep sell-off? Absolutely. From a technical perspective, a chart that goes vertical like that, you're always looking for mean reversion. And we saw that a little bit. If you look recently, we can go back at just the last year so you can see what happened in the short term with the TNX. But you've had some of these pullbacks, right? As we've attempted to move above previous highs, and then have pulled back a little bit and have had a meaningful drawdown of sorts. Having said that, so I think having a pullback in rates, having a bounce in bonds after the price has been going down for so much, makes a ton of sense. I thought Katie's chart of the TLT was a good one. I'm looking in the short term at a bullish momentum divergence where you have lower lows in the TLT, and I think the ag is showing a similar pattern here as well. And you have higher lows in the RSI. If we look at the last year, it's last 2 years, maybe last 1 year, it's going to make that a little more clear. Here's that bullish momentum divergence. Now that on its own does not get me excited. It puts it on a watch list for me, similar to what you saw in February, March of 2021, right? You have lower lows. The momentum is deteriorating. Finally, you have a new low on higher momentum. We're arguably seeing that right now. And so what that tells you, you could have a counter trend move. You could have bond prices bouncing higher as rates come off a little bit. That, generally speaking, as the Fed is basically raising the short end, the long end of the curve comes off a little bit. The curve flattens a little bit until you get back to more of a normal environment, and maybe we resume. And I think that's sort of the base case I'm seeing looking at the charts of the TNX and the TLT, a bit of a pullback in rates, or a bit of a bounce in bond prices before this move goes higher. I think 325, which is the resistance from the fourth quarter of 2018, certainly could make sense. And that's where I would be looking for further potential resistance. That would be a 100% retracement of that move as the 10-year yield has literally gained almost 3% in value from where it was at that bottoming point. Let's check in on the chart of gold, and that's where we'll finish our segment on Don't Fight the Fed here. Looking at the chart of the GLD, if you told me inflation was going to be more and more recognized as a potential issue, my initial thought is stronger gold prices, because that's sort of the traditional playbook, right? Investors are worried about inflation. What's a way to ride out inflationary concerns? Gold is usually a pretty good way to do it. What I did not think, or what I did not realize would be such a Detriment to an uptrend is gold is the strength in the dollar. And you've seen that dollar rally consistently through 2022. And as a result, things like gold have been held down quite a bit because of that increase. The chart of gold has been fairly negative, particularly in the last 6 weeks. Have you seen the spike higher in early March? From there, it's essentially been a downtrend of lower lows through that period. And so now you get a bit of a bounce as the dollar comes off today. Gold prices rally. What I would like to see, again, as a trend follower, is some sort of sign of accumulation. This is a chart still in distribution mode, and you'll have up and down swings during that trend. But what tells you that the trend is turning is you start to get a higher low. You start to get signs that the distribution is starting to stall out. There's an exhaustion of sellers or an influx of buyers, something that is causing prices to go higher. I'm not seeing that yet on the chart of gold. That's something I would certainly want to be something I'd like to see, or I'd want to be looking for. What's the upside potential in gold? Certainly could go much higher. If you look back on the GLD, the high over the last couple of years was in August of 2020. It was just below 200. It's pretty far below where it is right now, or pretty far above where it is right now, around 175 and change. So there's certainly some upside potential to be had. 180 could be an interesting level. That is a resistance level based on Fibonacci retracements, which has come into play before. It's also right about where the 50-day moving average is settled in right about now. So it might be a level to watch as we get, or if we get a further bounce in gold. That is our discussion on Don't Fight the Fed. Again, on Fed Day, a lot of movements. As always, take a step back and look at the long term. And with that in mind, let's go to our 3 and 3. 3 charts that tell the story of this market in just under 3 minutes. Here we go. Chart number 1 is the stock to bond ratio. Looking at the charts of interest rates, looking at the Fed's decision and the movement that you saw in the fixed income markets afterwards. What's interesting to me is when you look at the ratio of stocks versus bonds, even if you could get a bounce in bond prices, which I think we could be looking at here in the short term, overall, the relative performance of the stock market versus the bond markets, the SPY versus the TLT, has been clearly favoring stocks for quite some time, even with the pullback in stocks that we've seen at times. Even with the the bounces that you've potentially seen or you might expect in the bond markets, the trend overall has remained stocks over bonds. And I think you'd need to see quite a bit of a change in those markets to see a change in that ratio. It's still telling you equities are the places to be versus the relative defense of the fixed income markets. Chart number 2, just to remind us that earnings matter even on a Fed day. Starbucks bouncing along with many other stocks. But Starbucks almost made it up 10% today. It was up over 10% earlier in the day, settled in just below $82 a share. And that's a nice bounce from where we were at. What's interesting about this chart is it's been in such a consistent downtrend. I'm often telling people when a chart is just going down, that on its own should not be a good reason to buy a stock, right? Buying just because the chart is down a lot isn't great. And the reason is because prices usually go down for a reason. Prices don't magically just go lower over time consistently for no reason at all. There's usually a good reason why it does that. Earnings can often be a catalyst to make that change, right? To tell you that the market conditions are changing, to tell you that the downtrend, the price deterioration we've seen, whatever cause that has now been priced in, you're starting to see some gains materialize as optimism returns. The way you confirm that that's happening is you get a build from that earnings win. The chart of Meta Platforms may be a good analog for what we're starting to see on Starbucks, but I want to see some further follow through. Today's bounce in some way can be attributed to the Fed meeting, and everything was sort of bouncing up going into the close. But I'd like to see if Starbucks can mount a little more of an uptrend. Apache, I was going to say, I can't remember the name that I put in there. APA, that was a stock that I put in here as our last 3 and 3. I mentioned some of the other energy stocks. Energy, the top performing sector today, up over 4%. Apache was up over 6%, 6.3%, making a new 52-week high, 52-week closing high today for sure. And the reason why I think this is an important chart, again, it's an earnings name with a nice bounce, but I would also tell you that relative strength matters. My guest today, Katie Stockton, mentioned the strength in energy with relative strength. In any environment, it pays to stick with stocks that are working, but particularly in a market that is very uncertain. Folks, that's our show for today. I want to thank Katie Stockton from Fairlead Strategies joining us from Connecticut, sharing some of the charts that help put the Fed day into proper perspective. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.